You know, when I sit and look back at my long career in the markets, the lessons that stuck with me weren't the complicated ones. They were the simple truths I learned by watching the tape again and again until my mind could recognize a pattern faster than I could explain it. And today I want to talk with you about one of those truths, something every serious trader needs to understand if he hopes to build wealth from this business. Why volume confirms every breakout. And before we get into it, let me remind you this connects directly to the previous video on catch big moves before they start. Because a breakout without volume isn't worth your money, and catching a big move early is only possible if you can separate the false breaks from the real ones. So let me ask you, have you ever stared at a chart, watched the price punch above resistance, and thought you just caught the start of a fortune, only to watch it fold right back on itself the next day? I've lived through that pain myself, more times than I care to count in my early years. And do you know what separated the false promise from the real deal? Volume. Always volume. Because the market is nothing more than a crowd of men and women putting money where their mouths are. And when you see that swell in activity, that flood of orders, that's not noise, that's conviction. Without it, a breakout is just a feint, a little head fake that steals your stake and leaves you poorer for your impatience. Now I learned this lesson the hard way, and perhaps you have too. I used to take every breakout that showed itself on the tape. The price moves above yesterday's high, I'd buy. The stock pushes out of a range, I'd buy. More often than not, I was left holding something that didn't want to go anywhere. Why? Because there was no crowd behind it. A single man can mark the tape for a minute, but he can't change the trend. Only the public, with its weight of money, can do that. And how do you see the public stepping in? You see it in the volume. That's the first point I want you to carry in your mind. Price may show you direction, but volume tells you whether that direction will last. Now ask yourself, do you really want to put your money into a move that nobody else believes in? Because that's what you're doing when you buy a breakout without volume. You're acting alone, ahead of the crowd, but without their support. And trading, my friend, is not a solo business. You may enter alone, you may decide alone, but the market pays only when the crowd joins your side. The big money, the real fortunes, they're always made by aligning yourself with the tide of capital. That tide reveals itself through volume. When I see a stock breaking out with heavy turnover, with activity 2-3 times its daily average, I know I'm not the only one watching that level. Others are piling in. The crowd is shouting its agreement on the tape, and that's when I know the breakout is genuine. Now, some folks ask me, Jesse, why does volume matter so much if price is already moving? That's a fair question. Let me put it simply. Imagine a man lifting a heavy box. He may hoist it an inch or two off the ground to prove his strength. But can he carry it across the room? That depends on whether others step in to help. In the market, price can lift itself for a moment, but without volume, without help from other participants, it collapses under its own weight. Volume is the proof that the load can be carried, that the breakout has the strength to continue. And that's the way you must train your eye, not just to see the breakout, but to test its muscle. Look at the daily turnover. Compare it to the past 10 or 20 sessions. Ask yourself, is the crowd stepping in, or is this just a shadow move? Because every time I ignored that question, I paid for it. The tape punished me for my greed. Now, let me bring this closer to your own account. Think about the money you put into a trade. It isn't just numbers, it's your sweat, your time, your discipline. Do you really want to risk it on a move that lacks conviction? That's not just bad trading, that's bad stewardship of your capital. And let me tell you, the only way to last in this game is to treat your money like a soldier. Never send it into battle without support. Volume is that support. Volume is the army behind the breakout. Without it, you're sending your soldiers to their death. So here's a question for you. How often do you check volume before placing a trade? Be honest with yourself. Do you glance at it as an afterthought, or do you weigh it as heavily as price itself? Because in my experience, price and volume are inseparable. One without the other is meaningless. A price move without volume is a whisper. Volume without price action is noise. But together, price moving out of a range and volume swelling to confirm it, that's the signal worth betting on. I want you to remember something. The tape never lies, but it does whisper. The crowd tries to mislead you with false moves, with traps set by the operators. They'll push a stock above resistance, just enough to tempt the amateurs, but with light volume. Then, once the public takes the bait, they sell into that strength and the price sinks back. Only the trader who waits for the real swell of activity, who demands confirmation from volume, avoids that trap. That's why I say volume confirms every breakout, and if you're serious about building wealth in the markets, you can't ignore this. Wealth in trading doesn't come from chasing every move, it comes from sitting tight when the odds are weak and striking only when the odds are strong. And the odds are never strong unless price and volume move together. Ask yourself this: how many fortunes have been lost chasing head fakes, false breakouts, phantom rallies? Too many to count. And the common mistake behind them all is ignoring the tape's volume. When I was a boy trading in the bucket shops, I used to make money quick and lose it just as quick. Back then, I could recognize patterns, but I hadn't yet learned discipline. The moment I learned to wait for confirmation, my whole career changed. Because the market rewards patience far more than cleverness. Anyone can see a breakout, but only the disciplined man waits for volume to confirm it. That man keeps his money when others lose theirs. Now think back to what we discussed in the last video, catching big moves before they start. The truth is, you can't catch a big move if you're fooled by every little shakeout. Big moves don't begin quietly. They begin with thunder, and that thunder is volume. When a stock is ready to trend, you'll see it in the surge of transactions. That's the crowd stepping in. That's institutions putting serious money to work. And that's your cue. I've sat through hundreds of charts, watched them break resistance, and I can tell you plain, without that volume surge, 90% of those moves fail. The tape doesn't lie. You don't need to know why the crowd is buying. You don't need to know the news. All you need to see is their money flowing in, and you'll know the move has life. Isn't that simpler than guessing at stories or reading headlines? But let me be clear. Volume is not just about the breakout day. One day can fool you. The real test is the days that follow. A genuine breakout holds its gains on sustained volume. A false breakout collapses when the crowd disappears. That's why I tell you, don't just chase the first move. Watch how the stock behaves. Does volume continue to support it? Or does it dry up like a puddle in the sun? That's your answer. Think of your trading account again. Every time you take a position, you're investing not just money but opportunity. That capital could be sitting in cash, waiting for a better setup, so why tie it up in a weak breakout? Wealth in trading doesn't come from constant action. It comes from right action. You don't get paid for effort. You get paid for waiting until the tape tells you the odds are in your favor, and volume is the only proof you'll ever need. A breakout without volume is often a false move. That single line may sound simple, but let me tell you, it carries more weight than most of the complicated theories people like to dress the market up with. The tape itself is a living thing, and when you've watched it long enough, you realize it breathes through volume. Price may be the body, but volume is the breath. Without it, you're looking at a lifeless move, no matter how good it looks on the surface. Now think about it. What is a breakout, really? It's nothing more than the price crossing a line that traders have been watching. That line might be a resistance level drawn by the highs of the last few weeks, or it could be the top of a range that the stock has been bouncing around in. When price climbs above it, your first instinct is to believe something new has started, that the stock is finally breaking free to higher ground. But here's the trick: if the crowd doesn't show up, if there's no wave of buying behind it, then what you've got isn't a breakout at all. It's a trick of the eye. I've seen thousands of these. The price moves above the resistance point by a fraction. Maybe it holds for an hour, maybe for a day, and then just as quickly it collapses right back into the range, leaving behind all the eager traders who thought they had spotted the beginning of a trend. They're stuck with losses and worse, confusion. They wonder how they could have been wrong when the chart seemed so clear. But the truth is, they weren't watching the volume. Volume is the crowd's voice. When a real breakout happens, it's not just a line being crossed, it's a flood of money hitting the tape. It's a rush of orders that you can see plain as day if you're willing to look. The turnover swells, often doubling or tripling compared to the average. That's what tells you this move has life. That's what separates a genuine breakout from a false one. Without that, you're just watching a shadow move. Let me ask you, have you ever been fooled by one of these false breakouts? Be honest. You saw price clear resistance, you got excited, you bought in. And for a moment, you felt smart. Then, just as fast, the stock sank back and left you with nothing but regret. I've been there myself. In fact, that's how I learned the lesson in the first place. And every trader who lasts long enough learns it too. It's a rite of passage in this business, and the cost of ignoring it is always the same money lost to impatience. Now, why do these false breakouts happen? The answer is simple: operators, big players, and even natural fluctuations in supply and demand can push prices a little higher without any real commitment behind them. A stock might pop above resistance because a handful of traders got aggressive or because a few stops were triggered. But unless the larger crowd joins in, unless big money steps forward, there's nothing to hold that price up. It slips right back, and the breakout dies before it lives. That's why volume is your test. Price may tell you something is happening, but volume tells you whether it's real. Think about what it means when volume is missing. The price is moving, yes, but it's moving without participation. And trading is not a solo game. You may decide alone, you may enter alone, but you cannot profit alone. The market pays only when the crowd joins your side. Without volume, there is no crowd. You're standing out there on your own, hoping others will show up later, and that's not a business plan. That's gambling. I can recall countless examples. There were times in my early years when I'd rush into a breakout the moment it showed itself. I thought I was being sharp, catching the move before the rest of the crowd noticed. But the truth was, I was just being reckless. More often than not, the stock would pull back, and I'd be forced to sell at a loss. What was missing? Always the same answer: volume. When I finally trained myself to wait for the turnover, for that rush of activity that signals real buying, my results changed. The false moves stopped bleeding me, and the genuine ones started paying me. Let's put it in practical terms. Say a stock averages 1 million shares a day. You're watching it hover just below resistance for weeks. One day, it finally clears that level. The price action looks beautiful, but the volume is still around 1 million. No surge, no rush, just the same as it's always been. That is not a breakout. That is just price moving because a few extra hands pushed it. Now, take the same scenario, but this time the stock trades 3 million shares on the breakout. That's your proof. That's the crowd voting with real money. That's the kind of move that has weight. Ask yourself, which of those would you rather put your money into? The one that looks good but lacks support, or the one that's backed by undeniable participation? The answer is obvious once you think about it, but in the heat of the moment, most traders ignore it. They get caught up in the excitement of seeing price clear a level and forget that without volume, they have nothing. Don't make that mistake. There's another point to understand. Breakouts without volume are not just weak, they're dangerous. They attract traders who don't know better, and then they punish them. Operators know this. They push prices just above obvious levels to trigger the stops and lure the amateurs. Without volume, you should recognize it for what it is, a trap. That's why patience is so important. Don't rush to be first. Wait for the proof. The market will always give you another chance if you miss one move, but it will never return the money you lose by being reckless. You might be thinking, but Jesse, doesn't waiting for volume mean I'll be late? Not at all. A genuine breakout backed by strong turnover doesn't just move for a day, it moves for weeks, sometimes months. Catching it on the first day with no volume might feel clever, but it usually leaves you poorer. Catching it on the second or third day with confirmed volume may feel slower, but it puts you in step with the crowd. And that, my friend, is where the real money is made. Look at the greatest moves in market history. You'll see the same pattern every time. Price breaks out and volume surges to confirm it. That's not coincidence. That's the law of the market. Big moves require big money, and big money always leaves its footprint in the turnover. Without it, the move is nothing more than noise. Now tie this back to your own mindset as a trader. Your money is not a toy. It's the tool of your wealth, the foundation of your future. To throw it at breakouts without volume is like sending your soldiers into battle without backup. They may rush forward bravely, but they'll be cut down because no one followed them. That's what happens when you buy a breakout without volume. You're charging ahead alone, and the market punishes that kind of rashness. So when I tell you that a breakout without volume is often a false move, understand that I'm not giving you a rule for the chart. I'm giving you a principle for survival. Because trading isn't just about spotting patterns, it's about protecting your capital, aligning with the crowd at the right moment, and building your fortune slowly, steadily, on moves that have proof behind them. And proof in this business is spelled in 5 letters: volume. Light volume breakouts are often traps set by operators. If you've traded long enough, you've seen it happen. The price clears resistance. The chart looks like it's finally ready to run, and you think you're staring at the start of a major move. But then almost before you can blink, the stock reverses and falls back into its range, leaving you stuck. That's no accident. That's the tape doing exactly what it's designed to do, punishing the careless and rewarding the disciplined. And more often than not, when you trace the reason, you'll find it came down to volume. When I say light volume breakouts are traps, I mean they're bait. Think about who sets that bait. Operators, big players who have the power to nudge prices around, know exactly where amateurs are watching. They know the obvious levels. They know the moment a stock trades above resistance, eager hands will rush in. So what do? They push the price just high enough to trigger that excitement. But notice something important: the crowd hasn't really arrived. There's no swell of turnover, no flood of buying. It's just a little push, a staged move, designed to look like a breakout but hollow inside. Let me ask you, why would operators do this? The answer is simple. Because they want liquidity to sell into. Imagine you're holding a big block of shares. You can't unload it all at once without tipping your hand. The moment the market smells you're selling, the price collapses, and you get a worse fill. But if you can drive the price just above a key level, you trigger buy orders from the public. Suddenly there's fresh demand. Suddenly, the tape is filled with eager amateurs chasing a breakout. And now you can unload your shares into their hands at a better price. That's the trap. I've watched this happen again and again. A stock runs to a new high, volume stays weak, and the move doesn't last. The amateurs get caught, their stops are hit on the way down, and the operators walk away with their profits. It's as old as the market itself, and yet traders keep falling for it. Why? Because they're blinded by the line on the chart. They see price break above resistance and forget that without volume, the move has no real strength. This is why I say the tape whispers before it shouts. Price is only half the message. The other half is in the activity. When volume doesn't rise with the breakout, that's the tape whispering to you, don't trust it. And if you're wise, you'll listen. If you ignore it, you'll pay the tuition fee to the market, just as I did in my early years. Think about your own account. Imagine you put money into one of these light volume breakouts. You're risking your capital, your time, your confidence. And what are you risking it on? A move with no support. You're handing over your hard-earned money into a trap that was set for you. Does that sound like the kind of business a serious trader should be in? Of course not. But the reason traders fall for it is impatience. They want to act now, to be first, to catch the move before anyone else. They forget that being first doesn't matter, being right does. Let me share a lesson from my own career. In the bucket shops, I could spot a breakout in a heartbeat. My eye was trained to recognize those patterns. But I didn't yet understand how operators used volume to fool the public. I'd see a stock poke above resistance, and I'd buy without hesitation. Time and again. I was left with losses when the stock fell back. It wasn't until I began to pay close attention to turnover that I saw the trick. Those light volume breakouts weren't signals, they were setups, and the person being set up was me. Now ask yourself this: what separates a false breakout from a real one? The answer isn't the line on the chart, it's the crowd. Real moves require real money. They require institutions, funds, and the broader public putting their weight behind the price. That's why true breakouts are always accompanied by a surge in activity. Without it, the move is like a house of cards. Operators know this, and they take advantage of traders who don't. Think of the market as a stage. The operators are the actors, and the amateurs are the audience. The actors perform a little show, a light volume breakout, and the audience applauds by buying in. But the script is already written. The breakout collapses. The operators exit with their gains, and the amateurs are left with regret. If you don't want to be in the audience, you must train your eye to see through the act, and the way you do that is by checking the volume. There's also a psychological angle here. Operators know that most traders can't resist a breakout. They know it triggers an emotional response. People hate missing out. They see the price run above resistance and think, if I don't buy now, I'll miss the move. That urgency clouds judgment. In that rush, traders forget to ask the most important question: where is the volume? And that's exactly how the trap works. The operators prey on your fear of missing out. Let's make this practical again. Suppose a stock trades an average of 2 million shares a day. For weeks it's been stuck below resistance at $50. Then one morning it ticks up to 51. Traders rush in, thinking they've caught the start of a big breakout. But the volume on that day is still 2 million, no more than average. What's happening? Operators are pushing the price just enough to trigger those orders. Without volume, you should see it for what it is, bait. If instead the volume jumped to 5 or 6 million shares, that would be a different story. That would show real interest, real money stepping in. That's the distinction that saves you from being caught. So let me ask you, do you want to be the bait or the fisherman? Because when you chase light volume breakouts, you're the bait. You're playing the role the operators wrote for you. But when you wait, when you demand proof in the form of strong turnover, you flip the script. You're no longer the prey, you're the hunter. And that's the only way to last in this business. Another thing to remember is that these traps are not rare events. They're everywhere. The market thrives on pulling in the careless. The reason operators set them so often is because they work. And they work because most people won't take the time to wait for confirmation. They want action, they want excitement, they want to trade. But trading for the sake of trading is what fills the operator's pockets, not yours. Discipline is the dividing line here. You have to train yourself to look beyond the price and see the truth of the move. Light volume means light conviction. Light conviction means the breakout won't hold. And if the breakout won't hold, you have no business risking your money there. Your job as a trader is not to buy every move, it's to buy the right moves. And the right moves always come with volume. I'll say it again because it's that important. Operators use light volume breakouts as traps. They push the price just enough to make you believe, but without the crowd, without the surge of activity, it's nothing but an illusion. And if you fall for it, you're handing your money over to those who know better. True breakouts are supported by multiple days of strong volume. That's a fact I had to carve into my memory through both profit and pain, because it's one of those lessons the market insists on teaching you again and again until you stop resisting it. A single day can fool you. A single day of excitement can trick even the sharpest traders. But the market is not a one-day game. It's a test of staying power, of commitment, of whether the crowd really means what it showed on the tape. And that's why you can't measure the truth of a breakout by just one bar of volume. You need to see it carry forward across several days. Let's think about it step by step. When price pushes above resistance, That's the signal everyone watches for. It's like the starting gun in a race. But what happens after the gun goes off is just as important as the sound itself. On the breakout day, volume often spikes. That makes sense. Stops are triggered, momentum players jump in, and operators may even add fuel to the fire. The question is, does the crowd stay in the race after that first surge, or does it vanish as quickly as it appeared? If volume dries up the very next day, that breakout doesn't have a foundation. It's a house built on sand. Ask yourself this: have you ever chased a breakout that looked perfect on the first day, only to watch it stall the next? It's a common experience. Traders see the fireworks, they rush in, and then the show ends before they can even find a seat. That's because the surge in volume was temporary, not sustained. The real money, the institutional buyers, they don't move in and out in a single day. They're buying stretches over sessions, sometimes weeks, because they have size to accumulate. That's why multiple days of strong volume are the true sign of conviction. They tell you the big players are really behind the move. I'll give you an image. Picture a firework exploding in the night sky. It dazzles, it makes noise, and for a brief moment you believe the whole sky has changed. But then it fades and the darkness returns. That's a breakout on a single day of high volume. Now picture a rising sun. It starts with a glow on the horizon, then more light, then the whole sky brightens as the day begins. That's a breakout with several days of strong volume. It doesn't fade, it grows. It doesn't tease, it delivers. Which of those would you rather put your money behind? There's a rhythm to genuine moves, and it shows up in the tape if you care enough to look. On the breakout day, the surge is clear. The next day, maybe the price consolidates a little, but the volume is still above average. The following day, the buyers step in again, adding more shares, pushing turnover high once more. Day after day, you see that activity sustained, telling you the breakout wasn't just a flash. That's how you know the move has real backing. Let me ask you something: do you think institutions, funds, and operators with serious capital can buy their full position in one day? Of course not. Their orders are too large. If they showed their hand all at once, they'd move the price against themselves. That's why their buying is spread across days, often quietly, but visible in the turnover. So when you see a breakout followed by multiple days of strong volume, that's not just activity, that's the footprint of big money stepping in. And you want to be aligned with that, not against it. I can remember trades where this lesson was written in bold across the tape. In my early years, I'd jump into a breakout the moment I saw it, thinking I was clever for catching it early. Sometimes the first day fooled me: price surged, volume spiked, and I thought I had found a winner. But by the third or fourth day, volume collapsed, and the stock drifted back into its range. I'd be left holding something that wasn't going anywhere. That's the penalty for not waiting. Over time, I learned to demand more proof. Not just one day, but several. Not just a firework, but a rising sun. And here's where your discipline comes into play. Every trader feels the urge to act immediately. You see a breakout and you want to be in on it before it runs away. But what if the move doesn't last? What if that one day was all it had? The market punishes that kind of impatience. If instead you wait, if you demand that volume confirms the breakout, not just once but several times, you put yourself in the position of strength. You may enter a little later, but your odds are infinitely better. Think of it in terms of probabilities. A breakout with one day of strong volume may have a 50-day 50 chance of succeeding. Flip a coin, that's your odds. But a breakout with 4 or 5 days of sustained heavy turnover, that's not a coin toss anymore. That's the weight of evidence stacked in your favor. The crowd has committed, the institutions are showing their hand, and the move is less likely to collapse. Trading is not about certainty, it's about stacking odds. And multiple days of volume is the stack you want on your side. Let's put this in a concrete example. Suppose a stock has been capped at $100 for months. One morning, it breaks through to 102, trading 4 million shares instead of the usual 1 million. That's exciting, no doubt. But the next day, it trades only 1 million again, maybe even less. The price holds, but the activity is gone. That's not conviction. That's not follow through. Compare that with a breakout where day 1 shows 4 million shares, day 2 trades 3.5. Day 3 trades 5, and day 4 still holds strong at 3. That's the picture of commitment. That's where you want to be. Ask yourself, how often have you let the excitement of day 1 blind you to the weakness of day 2 or 3? How many times have you mistaken a temporary spark for a genuine fire? The difference is always the same. Sustained volume. It's the only thing that proves the crowd isn't just playing games. There's another angle worth mentioning. When you see a breakout with sustained volume, it changes the psychology of the market. Traders who missed the first day see the continued strength and decide they must get in. Shorts who thought the breakout would fail see the pressure building and are forced to cover. That secondary demand adds fuel to the move. The more days of volume you see, the more confidence spreads, and the stronger the trend becomes. It's a snowball effect, and it starts with those multiple days of turnover. The market is never wrong. It's you and I who are wrong when we try to tell it what it should do. The tape speaks louder than opinions, louder than hopes, louder than fears. And if you've been trading long enough, you know what I mean. You think you know better. You think your judgment is sharper. You convince yourself that the market owes you a turn in your favor, and then the market humbles you. Haven't you felt that sting yourself? Expert trading doesn't come from being smarter than the market. It comes from being smarter than your own impulses. That's the difference. The fellow who tries to outwit the tape, he always pays in the end. But the man who listens to it, who learns to sit tight when the time is right, and to stand aside when nothing is clear, that man gives himself a fighting chance. Tell me, how often have you lost money not because the market tricked you, but because you refused to follow your own rules? I learned long ago that the market isn't a place for stubborn pride. Pride costs money. Ego is the most expensive thing you can carry onto the exchange floor. The expert trader learns to leave it at the door. He comes in with an open mind and lets the action of the tape guide him. If the line of least resistance is up, you go with it. If it's down, you go with it. And if you can't read it, you stand aside. How many of you have the courage to do nothing when nothing should be done? Most can't. They feel the itch to trade, and that itch is the ruin of more men than bad markets ever were. The professional learns that doing nothing is often the hardest work in this game. But it pays. The amateur wants constant action. He wants to buy here, sell there, always busy, always moving. And what happens? Commissions eat him alive. Slippage takes his edge. The market grinds him down until he's working for everyone but himself. Haven't you noticed that the busiest traders are often the poorest? There's a lesson that separates the expert from the hopeful patients. The big money is not made in the buying or the selling. It's made in the waiting. Any fool can get into the market, and plenty do. But it takes a man of discipline to sit with a winning position long enough to let the trend carry him. How many times have you sold too soon because you were afraid of losing a small profit? And how many times did you watch the stock go on climbing after you got out, leaving the real money on the table? The expert trader never argues with the tape. He may have opinions, but the tape will always settle the argument. A stock doesn't rise because you or I like it. It rises because big demand pushes it up. It falls because big supply pushes it down. That's all there is to it. So why fight? Why insist the market must reward your logic? Tell me, what's more profitable, being right in theory or being right in your account? I've watched traders blow up because they believed the market had to obey their reasoning. They read the news, they built an argument, and they bought on hope instead of proof. But the tape doesn't care about your argument. It doesn't care about the news. It cares about the balance of buying and selling. That's all. If you can't read that balance, you're trading blind. Do you see how simple it really is once you strip away the noise? Expert trading is the art of clarity. Clarity of mind. Clarity of vision. When you look at the tape, you don't bring your baggage with you. You let the market speak. You don't force trades. You don't chase action. You wait for the right moment, the right setup, the right confirmation. and when it comes, you act decisively. Have you ever noticed that the best trades feel almost obvious, so obvious you wonder why everyone else can't see them? That's because you've trained your mind to wait. Waiting clears the fog. Waiting lets the market show its hand, and when the hand is shown, it takes no genius to play it. The genius was in the discipline to wait in the first place. That's where most men fail. They can't wait. They think patience is idleness. But patience is capital. Do you see that? Expert trading isn't about catching every move. It's about catching the important moves. The fat ones. The moves that change your fortune for the year. Those don't come every day. They come once in a while. And if you're too busy chasing pennies, you'll miss the dollars. Would you rather be tired from constant trading or wealthy from patient trading? And here's another thing the expert knows himself. He knows his own weaknesses. He knows his danger points. He knows where his emotions creep in. If you don't know yourself, you'll never last, because the market will find your weakness and press it until you're broken. Do you cut your losses quickly, or do you hold on, hoping the stock will turn around? Do you average down, throwing good money after bad? These are the habits that kill traders. Have you caught yourself doing them? The expert doesn't average down. He doesn't throw money at a losing play to prove he was right. He cuts it. He steps aside. He admits the mistake. And he saves his capital for another opportunity. That's survival. And survival is the first law of trading. Because without capital you don't trade at all. Isn't that the truth? Think of it like this: trading is war. Your capital is your army. Every time you throw soldiers into a hopeless battle, you weaken your position for the next fight. The expert commander doesn't waste his men. He fights only when the odds are with him. He waits for the enemy to show weakness, then strikes with full force. That's how you win campaigns. That's how you win in the market. Do you fight every battle, or do you choose your spots? Now, let's talk about pyramiding. The novice piles into a position all at once. The expert builds it carefully. He adds when the market confirms him, not before. He builds strength as the trend proves itself. That's pyramiding. It's the safest way to ride a big move. You don't risk heavy at the start. You let the market pay you as you prove yourself right. And if you're wrong, your loss is small, easy to bear. Doesn't that make more sense than swinging heavy on the first bet? The expert also knows the danger of overtrading. The market offers temptation at every turn. But every trade carries risk, every trade carries cost. The more you trade without reason, the more you feed the market instead of feeding yourself. Overtrading is the great disease of the hopeful. They can't sit still. They think more trades mean more profit. But in truth, more trades usually mean more losses. How many trades have you made just to be in the game, only to regret them? You see, trading at the expert level is less about action and more about restraint. It's about knowing when not to trade, as much as knowing when to trade. That's what the crowd never understands. They look for excitement, but the professional looks for profit. Excitement is cheap. Profit is dear. Which one are you after? I've said it before, and I'll say it again: the market is a place where the strong take from the weak. Not through cheating, not through trickery, but through discipline. The weak trader gives up his money because he lacks control. He trades on emotion. He wants to be right. He wants to be entertained. He wants to feel clever. The strong trader takes that money because he's learned to do the opposite. He controls himself. He trades less. He waits longer. He risks smaller until the big play is ready. Isn't that fair? One man pays tuition for his mistakes. Another collects because he learned his lessons. The expert has learned to be comfortable with boredom. The waiting, the stillness, the days when nothing lines up that's part of the business. The amateur hates boredom. He wants thrill. And thrill seekers get punished. The market has no mercy for gamblers. Do you treat the market as a casino or as a business? Trading is not about predicting the future. Don't let anyone fool you. It's about reading the present. The tape tells you what is happening now. Not what might happen tomorrow, not what you hope will happen next week. What is happening right this moment? And that's enough. Because if you learn to follow the line of least resistance in the present, The future takes care of itself. Have you ever noticed that the men who try hardest to predict are often the ones who lose the most? The expert doesn't pretend to know. He doesn't pretend to be smarter than the market. He just reads what is. If it's bullish, he's long. If it's bearish, he's short. If it's unclear, he's flat. Simple as that. No need to forecast. No need to argue. No need to prove anything. Just follow the line of least resistance. Can you imagine how much money you'd save if you stopped trying to predict and just followed? Big money is made in the waiting, not the trading. That truth is simple enough to say, but it takes a lifetime to really learn it. Most men who come into the market think the opposite. They believe the way to make money is to trade more often, to be in and out of stocks every day, to keep their money working by keeping themselves busy. But the truth, the cold truth, is that the more you chase action, the less you give yourself a chance to sit in the kind of position that changes your life. Haven't you ever wondered why the crowd always seems busy but never seems rich? The waiting is where the real profit lies. It isn't glamorous, and it doesn't make for a good story to tell your friends, but it is the only way I ever saw a fortune built in the market. Think about it. You can buy a stock today and sell it tomorrow for a point or two, and maybe you feel clever for making quick money. But where is the real reward? Where is the move that takes you from small profits to big success? It's in holding a stock when it runs from 30 to 60, or from 60 to 120. It's in letting the trend pay you, not trying to scalp pennies off the tape. And to do that, you must wait. Do you have the strength to wait, or do you grab at crumbs while the feast is still in the oven? Every trader thinks he can outsmart the market with quick action, but the market isn't a place where cleverness pays. It's a place where discipline pays. When you jump in and out all the time, you're cutting off your own profits before they can grow. You're trading like a farmer who digs up his seeds every morning to see if they've sprouted yet. If you don't give them time, you never get the harvest. Haven't you done the same with your trades sold too soon, only to watch them double after you got out? It takes nerve to sit still. It takes courage not to do something, not to fiddle, not to cut your winners short because you're scared of losing a little paper profit. Most men can't do it. They want action. They want to ring the cash register, but the expert trader knows that ringing it too often means it never fills up. The register fills when you let your winners run. And that means you sit tight, no matter how itchy your fingers get. Can you stand to watch a stock wiggle and jiggle without letting go of it too soon? I learned it the hard way. Early in my career, I made small wins and big losses. I'd sell the moment I had a profit because I was afraid of seeing it vanish. But then I'd hold on to my losers, waiting for them to turn, waiting for the tape to forgive my mistake. That's backward. That's how most traders lose. The right way is to cut the loser quick and let the winner grow. And the letting grow, that's where the waiting comes in. It's the sitting, the holding, the doing nothing while the tape works in your favor. How many times have you reversed that rule and paid the price? The crowd thinks waiting is wasted time. They think if they're not trading, they're missing out, but waiting isn't wasted, it's investing in patience. It's giving your trade room to breathe. You don't get rich by trading more, you get rich by trading better. A handful of big moves a year can make more money than 100 small ones, yet who has the patience to wait for those big moves? Do you? The tape will always tempt you to act. Prices will shake, news will fly, rumors will buzz. Every tick seems like a reason to jump, but the expert ignores the noise. He sees the larger picture. He knows that the small fluctuations are just ripples, not the tide, and the tide is what makes the money. You don't set sail to chase ripples, you wait for the tide and let it carry you. Do you chase the ripples, or do you ride the tide? I remember watching stocks move in long waves. The amateurs would buy in late, sell out early, or trade in and out so many times they ended up with nothing but commission slips. Meanwhile, the man who bought right and sat still made a fortune. It looked easy from the outside, but it wasn't easy at all. It took more strength to sit than to trade. Most people don't realize that. They think action means strength, but in this game, Patience is strength. Haven't you noticed how much harder it is to do nothing than to do something? The market is a great teacher of patience if you let it be. Every time you cut a winner short, you teach yourself the wrong lesson. Every time you wait and let the trend reward you, you prove the truth of this principle. The waiting is what builds confidence, because you see with your own eyes how much money comes from sitting. And once you've felt that, once you've watched a stock run far in your favor because you refuse to sell too soon, you'll never forget it. Have you ever had that one trade that finally taught you to sit tight? Of course, waiting doesn't mean stubbornly holding everything. It doesn't mean ignoring your stops or your rules. It means once you are right, once the market proves you're right, you don't second-guess yourself. You don't snatch at profits like a nervous thief. You sit like an owner, letting the market hand you its reward. That is the waiting I speak of. That is where the big money lies. The trick isn't getting into the right trade. The trick is staying there long enough to collect. Isn't that where most traders fail? The tape doesn't pay men who are impatient. It punishes them. Impatience is the tax that amateurs pay. They sell too soon, they buy too soon, they move too soon. And every time they do, they give their money to the trader who has learned to wait. The market is a machine for transferring wealth from the impatient to the patient. That's as close to a law as you'll find on Wall Street. Do you want to be the one paying that tax, or the one collecting it? It's easy to talk about waiting, but it's not easy to practice. Your mind fights you. Your fear fights you. Your greed fights you. You want to lock in a gain before it slips away, or you want to grab more too soon. But the expert learns to silence those voices. He knows the real work is not in finding trades, but in holding them. The real battle is not against the market, but against his own impulses. Have you ever noticed that your worst enemy in the market is usually yourself? Big moves are rare. They don't come every day, every week, or sometimes even every month. But when they come, they pay for all the waiting, all the boredom, all the discipline. And if you miss them, if you cut them short, you'll always wonder why your trading never seems to add up to much. The answer is simple: you didn't wait long enough. You didn't give the trend time to reward you. You wanted quick results, and quick results are small results. Is that what you're after, small results? The greatest traders I ever knew weren't the ones who traded most often. They were the ones who could sit still. They weren't rushing in and out. They weren't showing off their clever trades. They were quietly holding, quietly waiting, quietly letting their money grow while the crowd exhausted itself. They understood the power of time. They understood that waiting is not weakness, but strength. Can you see now why the big money is always in the waiting? Overtrading is the surest path to ruin. Nothing empties an account faster than the constant need to be in the market, buying and selling with no real plan, no clear signal, no patience to wait for the right spot. Overtrading is like a disease, and the worst part is most traders don't even know they have it until the damage is done. They feel the itch to act, and they scratch it by jumping into trades that have no business being made. Haven't you felt that pull before? That restless urge to click the button just because you couldn't stand sitting on your hands? The market tempts you with endless opportunities. Every tick, every movement, every rumor feels like a chance to make money. But not every movement is worth your money. Most of them aren't. The expert trader knows this. He understands that the tape is a constant flow of noise, and inside that noise are only a few true signals worth trading. The amateur, on the other hand, thinks every tick is an invitation. He confuses activity with opportunity, and he pays for that mistake. How many times have you looked back at your trades and asked yourself why you even made half of them? Overtrading doesn't just drain your account through bad decisions. It drains it through cost. Every time you trade, you pay commissions, spreads, slippage. Those small costs pile up like termites eating at the beams of your house. Slowly but surely, they hollow out your foundation until the whole thing collapses. The man who trades 20 times a day needs to make a fortune just to cover his costs, while the man who waits and trades sparingly can let his profit stay in his pocket. Do you see how the busy trader works for everyone but himself? The biggest problem with overtrading is psychological. The trader feels the need for excitement. He thinks he has to earn his living by being constantly active. He gets bored when he's not in a position. He feels like he's wasting time if he's not pressing buttons. But the market doesn't reward activity. It rewards accuracy. And the more you chase action, the more likely you are to miss accuracy. Haven't you noticed how the busiest traders always seem the most tired and the most frustrated? The expert looks at trading as a business. A business has overhead, it has risk, it has inventory. If you keep buying and selling inventory without discipline, you bankrupt the business. The professional treats every trade like a serious investment of his capital. He doesn't throw it around like pocket change. Overtrading, in that sense, is like gambling at every table in the casino. You can't win them all. The odds will grind you down until nothing is left. Do you gamble at every table, or do you wait for the one where the odds tilt your way? When you overtrade, you also cloud your judgment. You stop seeing the market clearly. Every new trade becomes a blur, a reaction to the last loss or the last win. You're no longer trading with a plan, you're trading with emotion. That's the fastest way to spiral downward. A string of quick losses makes you desperate, and desperation leads to bigger mistakes. Before you know it, you've doubled your position, averaged down, ignored your stops, and you're staring at a hole you can't climb out of. Haven't you ever chased your way into a disaster after one bad trade? The cure to overtrading is discipline and patience. But patience feels like pain to most men. They think waiting is weakness. They think if they're not active, they're missing out. But the truth is, you miss out far more by forcing trades than by sitting tight. The market doesn't punish you for waiting. It punishes you for being careless. Every unnecessary trade is like handing your wallet to the house and asking them to take a little more. Why would you do that to yourself? Overtrading also blinds you to the real opportunities. When you're constantly in motion, constantly chasing the next tick, you can't see the big move when it comes. You're too tied up, too worn out, too committed to small plays. The expert knows that you have to stay light, stay patient, and keep your powder dry for the right moment. You can't catch the big waves if you're splashing in every ripple. Have you missed the fat move because you were too busy chasing the thin ones? There's also the toll it takes on your emotions. Overtrading leaves you drained. Every entry, every exit, every decision burns energy. And when you burn yourself out on small trades, you don't have the strength left to manage the big ones. Trading is not only about money, it's about mental capital, and mental capital wasted on overtrading is as costly as dollars thrown away. Have you noticed how exhaustion makes you careless? The market doesn't care how often you trade. It cares how right you are when you do. The expert measures success not by the number of trades he makes, but by the quality of the positions he holds. He knows that one or two strong trades, managed with patience, can pay for an entire year. The overtrader never gives himself the chance, because he's too busy bleeding his account dry on the small stuff. Which one do you think survives longer, the man who trades constantly, or the man who trades wisely? Another danger in overtrading is that it builds false confidence. A few small wins in a row can trick you into believing you've mastered the market. You start trading more often, pressing harder, stretching further, and then the market reminds you that small wins don't make you safe. In fact, they make you vulnerable, because they encourage you to overreach. And when the hammer falls, all those small gains disappear in a single stroke. Have you ever given back a week of work in one afternoon? Overtrading keeps you from being selective. The expert knows he has to be choosy. He doesn't have to swing at every pitch. He waits for the fat one. But the overtrader swings at everything, and the strikeouts add up. Discipline means passing on trades that don't meet your standard. Overtrading means lowering your standard until anything will do. And when anything will do, you'll end up with nothing. Isn't it harder to say no to a trade than it is to jump in? The funny thing is, most traders overtrade not because of opportunity, but because of boredom. They can't stand to watch the market without being part of it. They don't want to feel left out. They see others making moves, and they think they have to be involved. But trading isn't about keeping up with others. It's about protecting your own stake and waiting for your own pitch. The expert doesn't mind being bored. He'd rather be bored with his money safe than entertained with his money gone. Can you honestly say you'd choose the same? When you look at the records of great traders, you'll notice something: they didn't trade every day. They didn't trade every week. Sometimes they sat for months, waiting for the right setup. And when it came, they struck hard, they struck big, and they made their year in one move. That's the way it works at the highest level. The rest of the time, they did nothing. Overtrading would have ruined them, just as it ruins countless traders every day. Do you think you're stronger than the law of averages? Overtrading is a slow bleed. It doesn't always feel like disaster at first. It feels like work. It feels like effort. You're busy, you're active, you're alive in the market. But day by day, the losses pile up, the costs eat away, the fatigue sets in, and suddenly you realize you've been running in circles. That's when most men give up, blaming the market, when the truth is they defeated themselves by trading too much. Haven't you seen it happen to others, maybe even to yourself? Cut losses quickly, never average down. That is one of the oldest truths in trading, and yet it is the one most men ignore. They ignore it not because they don't know it, but because they don't have the discipline to follow it. Human nature wants to believe that a bad trade will turn around if given enough time. Human nature hates admitting it was wrong, and so the losing position is held, defended, justified, and even added to. But the market has no mercy for human nature. The market only respects discipline. Have you ever found yourself holding on to a loser just because you couldn't bear to admit the mistake? The first loss is the best loss. That is something I had to learn the hard way. A small loss is like a scratch, it stings, but it heals quickly. A large loss is like an open wound. It weakens you, drains you, and can put you out of the game entirely. Every big loss I ever saw started as a small one that someone refused to cut. That is how fortunes are destroyed. Do you see how easy it is to stop the damage at the start, and how impossible it becomes once you let it grow? The temptation to average down is the deadliest trap of all. A stock goes against you, and instead of cutting it, you convince yourself to buy more. You think you're lowering your cost. You think you're being clever. But what you're really doing is throwing good money after bad. You're deepening your exposure to a trade that already proved you wrong. That is not courage, it is stubbornness. And stubbornness in this game is punished without mercy. Haven't you watched traders average down until their account was wiped clean? Averaging down is the hope trade. It's the belief that the market must eventually come back to your price. But the market doesn't owe you a return. Stocks can go much further than you think, and they often do. What looks cheap can get cheaper. What looks oversold can be sold even more. And while you wait for your miracle, your capital is tied up in a bad position that eats at your confidence and robs you of the chance to take better trades. Isn't it true that the money stuck in a loser is money you can't use on a winner? The expert trader never argues with the tape. If the tape says he is wrong, he accepts it. He takes his medicine quickly and moves on. He knows that survival is everything. Capital is his army, and he doesn't waste soldiers in hopeless battles. But the amateur treats the market like a debate. He insists on proving his point. He doubles down when the tape says he's wrong, until the tape breaks him. Which kind of trader are you, the one who fights, or the one who survives? Cutting losses quickly doesn't mean you lack conviction. It means you respect the market more than your own ego. It means you understand that being wrong is part of the business. No trader wins all the time. The expert expects losses. He plans for them. He makes them small, so the winners can take care of the rest. But the trader who refuses to cut a loss turns a business expense into a catastrophe. Have you ever thought about how much easier trading would be if you treated losses as part of the cost of doing business? The beauty of cutting losses quickly is that it gives you freedom. Freedom to trade another day. Freedom to take the next opportunity without being chained to the last mistake. A trader who carries big losses loses flexibility. He is trapped, waiting and hoping, watching his equity drain away while the market moves on without him. A trader who cuts losses quickly is light, nimble, ready. He can strike again when the real chance appears. Do you want to be chained to yesterday's mistake, or ready for tomorrow's opportunity? I've seen more men ruined by refusing to take a small loss than by any other single mistake. They don't just lose money, they lose time, they lose nerve, they lose faith in themselves. A bad trade that lingers becomes poison in the mind. It makes you second-guess every decision. It fills you with regret. And that poison spreads until you can't trade with clarity anymore. That is the hidden cost of not cutting a loss. It doesn't just damage your account, it damages your confidence. Have you ever noticed how one stubborn trade can ruin your whole rhythm? Averaging down appeals to pride. Pride whispers, I can't be wrong. The market must come back. Pride whispers, I'll prove them all wrong by holding on. But pride has no place in the market. The tape doesn't care about your pride. The market doesn't bend to your will. The expert knows this, so he checks his pride at the door. The amateur carries it like a badge, and it drags him into ruin. Which voice do you listen to, the voice of pride or the voice of discipline? The quick loss is your insurance. It's the small price you pay to protect yourself from disaster. Think of it as a toll you pay to stay on the road. Every time you cut a loss quickly, you buy yourself another day in the market, another chance to catch the big move. Every time you refuse, you gamble your entire stake on the hope that you're right and the market is wrong. That's a dangerous gamble, and it's one you don't have to take. Haven't you noticed that traders who survive longest are the ones who are quickest to admit mistakes? The hardest part about cutting losses quickly is emotional. It feels like failure. It feels like giving up. But it's not failure, it's strategy. It's business. It's the cost of staying alive. Once you train yourself to see it that way, you stop fearing the loss. You see it as a tool, not a punishment. You see it as part of the process. And once that shift happens, you'll never again let a small loss grow into a large one.